I want to welcome in Mr. Matthew Tuttle from Tuttle Capital. Can you give us a brief introduction? It's the first time I've had you on.
Yeah, no, thank you for having me. So yeah, Matt Tuttle, run Tuttle Capital. We're an ETF issuer. I don't know, a little more than 50 ETFs. I always lose track, close to 5 billion. Yeah, I'm also, I think, unique among ETF issuers in that I'm an active trader. So I've been trading since before you were born. And and have really over the past, say, 30 years or so become more of an options guy than anything else. So most of my portfolio is options. I'm either buying, outright calls or I'm selling puts for the most part. And every once in a while, I'll do some complicated spread type of things as well. So that's me.
What is your favorite option?
My favorite option. I think all things being equal, I like buying long dated calls. I'm a big fan of asymmetry. So we teach investors something called the heat formula: hedges, edges, asymmetry, and themes. And I'm a big fan of asymmetrical trades, meaning you're right, you make a lot of money, you're wrong, you lose a little. And there's almost nothing better than a call option, because when I buy a call option, I know exactly what my risk is and my gains are unlimited, which is why I almost never do call spreads, because now I'm limiting my gains. I don't like doing that. So that's my favorite. I do like selling puts as well, but that I look is more of an edge. That is not an asymmetrical trade. You can lose a lot of money selling puts, and and your gains are limited. But I do like mixing that in because, again, I think you've got an edge selling puts because most of the time the market goes up.
Yeah, like could you do a long call and sell a long put? That way you're getting the massive premium
Right.
while
There you've got a synthetic long.
yeah.
We do that in our ETFs, obviously, to gain, exposure to the underlying, save cash that we can put into T-bills. It's just, that's not an asymmetrical trade. So that's the only issue I have with that. I mean, that gives you the same payout structure as owning a stock, which, I'll do. I'll buy a stock from time to time, and you can make a stock trade asymmetric by buying a disaster put, and then at least you've got known downside and unlimited upside. I just don't like unlimited downside and unlimited upside at the same time. I'll take unlimited downside as long as you give me unlimited upside, though, which is why I don't like most covered call strategies, because you limit my upside and I've got unlimited downside. That I've got a problem with.
Oh, well, let's segue right into it. Tell me more about this covered call strategy that you don't like.
Well, so I really don't like what's out there because, when I first started investing, covered calls was a thing that like old people did. Now I am actually an old person, so that's a little weird. But yeah, and they buy Procter and Gamble, McDonald's, Coca-Cola, stodgy dividend stocks. It didn't move a lot, and they'd sell calls against them. So they get the dividend plus a little bit of call premium. Cool. I mean, that, totally fine. This market is morphed where you've got people like who have kind of rebelled against the traditional Wall Street model and are doing things yourself and connecting to communities of investors. And it's made the market a lot more thematic. And a lot of these thematic companies can really, really move. So it makes sense that the marketplace has shifted to doing covered calls on those. But the problem is there's a huge difference selling a call on Procter and Gamble than there is on, say, MicroStrategy. Because Procter and Gamble is not going to be up 30% in a month. MicroStrategy can be. and MicroStrategy can be down a lot. So basically what you're doing is you're limiting your upside for wherever you put your call, and you've still got the unlimited downside. I don't like that. Especially don't like doing it all the time. If you tell me, hey, I'm watching the chart, and every once in a while, when MicroStrategy gets overbought, maybe I'll sell some calls against it. All right, I won't argue with you. But selling calls against volatile thematic stocks that can go up a lot all the time just doesn't make sense to me as a smart investment strategy.
Okay, well, let me ask you this one. I got into the quantum space, right? I was thinking thematic about 6 months ago. I, 600,000%, not, it completely destroys my Apple and Google position I bought a decade ago, but not even close. And then I decided I would do covered calls against them, which is, so now I'm at like a negative 200 cost basis because my covered call premium I collected is 2x what I actually paid holding the stocks this whole time. What do you think of something like that?
So you're looking at it from a much, I hate to use the word, all right, a better word, a much more informed perspective, where you're looking at it from, a trader mindset, going in, looking, all right, here's what I bought it at, here's all the metrics, versus just blindly every week, every month, every quarter, we're selling, calls on this. But you're also most likely, managing your strike price for upside, where, I get concerned where maybe like an ETF issuer might be more concerned with the shiny object, which is the distribution yield, and, is willing to give up a little more upside, which, I would argue you don't want to do in a quantum stock, because we've seen, how these things can run.
Mm-hmm. I mean, it's been hugely profitable because the other day, quantum fell, sold, made a ton of money, did it again, and now I'm up like 4x. Well,
right. So, but you're trading this stuff. You're trading yourself. You also have a lot more flexibility. So one thing that happens with these ETF guys trading in massive size is you've got the Jane Streets and the Susquehannas on the other side of those trades. They're crushing them.
mm-hmm.
So it is much easier for you to do that, as your own, versus like, an ETF that's got billions, where everybody knows, hey, these guys are always in the market this day, and you see the order, you know who it is. And, there's a reason Jane Street and Susquehanna make so much money. It's taking advantage of people who have no choice and have to place a trade.
And you have to place a trade, right, as the ETF provider?
If you are doing something weekly, monthly, quarterly, then yeah. I mean, the cool thing with our zero DTE stuff is, we can sit around, we can wait, we can look, we can do, half the portfolio, we can do the whole portfolio, we can do 3/4. We can short at 10 and cover at 11 and call it a day. The cool thing for us is every day is its own, its own event, and we can kind of decide accordingly. But yeah, if you're doing weeklies, monthlies, or quarterlies, I mean, you kind of you got to sell your option.
Tell me more about this BITK. You guys just launched. I think we're going on week 4 now. Can you get into the details about how that works?
Yeah. So the idea there is we only want to be trading options intraday, because especially with Bitcoin. So BITK tracks IBIT, which tracks Bitcoin. Bitcoin moves a lot after hours, moves a lot over the weekend. So if we were selling weekly calls, monthly calls, quarterly calls, and Bitcoin ramped over the weekend, we're giving up upside. we're only selling calls during the day and we're covering them during the day. So what we're using there is something called a flex option. And, most people probably wouldn't be aware of flex options. I don't think, and I may be wrong, but I don't think individual investors could call up like Webull or Schwab and trade flex options. But as an institutional trader, we can. And so the way I look at flex options, listed options are buying a suit off the rack, flex options are customized. So I can customize everything, the day they expire, the exact expiration price. I can make them European. In some cases, like with IBIT, I can make it cash settled instead of, delivering shares. So in that way, we're able to trade options every single day. And, by the end of the day, we're out. And so if Bitcoin ramps overnight or in the morning, we're capturing all those gains. And then we can make a decision every single day, hey, where do we want to get in? And we could do it at 9:30. We can wait. We can see what's going on. Trump is giving a news conference at 10:30. You know what? Let's wait. Let's see what Trump has to say. So we've got complete and total flexibility there. And then we just launched MSTK yesterday, which is the same thing with MicroStrategy.
Okay, I will say I haven't looked into the MicroStrategy one yet, but as far as the BITK, I've been tracking it just about every morning because I have indicators tracking IBIT and BITK, and because of your zero DTE strategy, if IBIT, and I have all the other ones that also track it because there's like 4 others.
Right.
If IBIT is down, -1, the other ones are down, 2%, 3%. But BITK is always actually beating the underlier in the downward market because you're not subject to that overnight market. So that's great for investors.
Exactly. And that's why we did it. I think you've got such an advantage just trading options during the day and leaving that overnight and over the weekend unencumbered.
Do you think that strategy will have to change at all? I know that the CBOE is getting ready to extend the options hours, and then the CEO of the NASDAQ is looking to make all ETFs 24/7 for traders. Will that strategy have to change?
I don't think so. I mean, we're monitoring all of that. What I am more interested in is I believe that things like IBIT and MicroStrategy, we will get listed Monday, Wednesday, and Friday. And again, we can trade the flex, but when you're trading flex options, it's not as efficient a marketplace as the listed. Plus, I like options on options. So, when we get Monday, Wednesday, and Friday, every day we can make a decision. Hey, do we want to customize and we'll go flex, or do we want to just do the listed? So that's going to give us options. And I do think eventually we will see zero DTE on listed on everything that has active weeklies. There's so much interest in it, so much money in it. So I think those are the things that will be more game changers for us. Even if we can trade options in the pre-market, I don't think we will, given, unless we just see an opportunity that we can't avoid. Like, I could see a situation where we have an economic number at 8:30, it comes out disappointing and something is starting to tank. Yeah, you know what? I may sell a call then. So, that's a possibility when and if that happens.
Interesting. Okay, so you think that now, is this based on because I've looked at a bunch of funds, some ETFs don't have any options, or stocks, anything, have any options available. Does it have to do with the volume? Like if volume spikes, say on, I don't know, any number one of your funds, if the volume spikes, can you turn it to zero DTE, or is that like a total market has to go that way?
You lost me there. What do you mean?
Can the fund manager say you have a weekly, not that you will, but say you have
right now, yeah, I wouldn't, but all right, go ahead.
at any point, can you just go, we're just going to go zero TTE because we can? Or is that like the entire market has to go zero TTE?
No, so any fund manager out there, as long as it's in their prospectus, could decide, hey, I'm using weeklies, I'm using quarterlies, I'm using monthlies. Yeah, I'm going to go to flex options, for whatever reason. So they could. I don't. I think most managers out there would kind of look at it from the standpoint of it, if it ain't broke, don't fix it. So, if I'm sitting there and I'm selling weekly options and I got $1 billion in my ETF, am I going to change? I doubt it. Now, if our stuff takes off and I'm sitting on billions, are people going to come after us and do the same thing? 100%. I mean, this is a business where you want to be first, but if you're not, you still want to go to where the puck is. I mean, we saw a big issuer just turn all of their monthly dividend payers into weekly dividend payers. Why did they do that? Because they're looking and seeing everyone now wants, weekly, so they're going to go to weekly.
Is there any, from the fund manager's perspective, now this is my own personal bias and I'd love for you to touch on it, paying out a weekly dividend and say half of the people that receive that dividend don't reinvest, right? So that reduces the NAV a little bit. Does that mean that maybe the next following week, the distributions, like you wouldn't have, say 500 million leaves the account, that's 500 million less that you'd be able to trade and collect options on. Is that of concern at all?
No, not at all. What I'm looking at is not the assets, it's the NAV, which is the assets divided by the shares outstanding. So whether you reinvest or not doesn't impact me. And we kind of go under the assumption that most people are not going to reinvest. So yeah, that doesn't have an impact. Now, obviously, as a fund manager who gets paid on assets, I would love for you to reinvest, but these are tools, and everyone's going to use these tools in the way that makes sense to them.
Mm-hmm. NAV erosion is a huge concern across everyone. So is like return of capital. Where do you stand on those two things? Do you just say, it's part of the equation, we kind of baked it in there, or do you take a stance against it? Like that's the absolute thing we want to prevent. How do you feel about that?
So I want to be as intellectually honest with our products as I can. So, I think a big problem is distribution yield and what that means. So, and the fact that I, as the fund manager, can decide exactly how much I distribute. And distribution yield has become kind of that shiny object. And I think, in looking through kind of social media, I think a lot of people are starting to get a lot more sophisticated on wait a second, you're paying 100% dividend, but 99% of it is return of my own capital. I think more and more people are starting to get that, but not everybody does. So, we definitely want to preserve NAV as much as possible. I think another thing people need to keep in mind, like I'll see from time to time on Twitter, here are the 20, ETFs that don't have NAV erosion. Remember, we've been in a bull market for 2 years. So, if you've been around for, a year, 2 years, whatever, and you're in some of these high flying stocks and you have NAV erosion, I think that's awful because you've got gains like crazy. You should be making money, writing the calls, you should be making money on the underlying, and you should just be distributing gains, in my opinion. Once we hit a bear market, you're going to have a problem because, are you going to make enough just from the options to generate distribution yields that that are going to entice investors, or my hope, investors understand, and we're seeing it. So I mean, Cy at T-Spy, we run T-Spy for them. We do the operations. I think Cy does a great job of that. He's like, hey, we're only paying out 14.8%. I mean, that's not 100. It's not 50, but we're going to be intellectually honest about it, and we're going to try to keep our NAV from eroding. Mm-hmm. I think that's the way to do it in a perfect world.
And I like what Cy does. Instead of at the end of the year, some of these other ETF funds, they'll give out a huge distribution in December, like all the excess capital. And Cy told me that he actually kind of puts it forward, throws it back into the NAV. They get, investors get the appreciation. It rolls over to the next year. It's kind of a nice hedge.
Yeah, I agree. I mean, I think Cy does it the right way, and and we're trying to mimic a lot of what he's doing. I think we're probably a bit more sophisticated from the intraday trading standpoint. And, I've got a much bigger staff than Cy does. So I think we can be a little more discerning on when we sell an option and when we buy it back. But, beyond that, we're trying to mimic what he's doing as much as we can, because I think he's doing it the right way.
I like how you put that, intellectually honest, because I think that's kind of where because you said we're in a bull market, right? And if you're still losing money in a bull market, like what are you doing? Right. I always view things as, you have to, at the very least, you should say, would I have made more money just holding the SPY? At my year over year.
And on every fund, what I would suggest is compare it to the underlying, and some of them are not even close. Like, you would have made way more on the underlying. I won't name names, but you probably know who I'm talking about. Some of them are not even close to the underlying. And, you could argue, well, buying the covered call strategy is different. Like, yeah, I'd buy the underlying, do what you do, occasionally sell calls, or do what I would do is occasionally sell puts. And if you're making money on the underlying, take some of your gains, which I advise people to do, especially, in this market. You should be taking gains. At some point, this is going to turn. Nobody knows when that point is. So, along the way, take your gains.
Well, it's funny you said that. So yesterday I got a notification that the Fed was they bought like $5 billion in tips, 5-year tips. So maybe they're pricing in inflation, a little bit down the road. Any thoughts on that? Have you seen that from your institutional side?
So I think the sense in the institutional side is inflation's going to be higher. And the fear is that we have a stagflation environment. I think there is very little trust in the Fed. There's very little trust in central governments. I think we're seeing that in what's going on with crypto and gold. I mean, not the past couple of days, obviously, but nothing goes up in a straight line forever. One of the things we've been on, I do a daily newsletter, is that debasement trade. And that's one of the reasons. I mean, it's not an option fund, but we run BEGS, which is Bitcoin, Ether, gold, and silver. And it's a levered fund. It's 75% gold, 75% Bitcoin, 25% Ether, 25% silver. That is the perfect debasement trade portfolio. And I don't see that trade going away. So I do think there's a big lack of confidence in central banks, in the Fed, and a fear of where things are going from that standpoint.
The next 2 months, are you pricing in bull markets with the implied interest rate drop?
So I'm never pricing in anything. I tell people, keep your head on a swivel, because you never know what's going to happen. Like every one of these momentum sell-offs we've seen. So we just saw one, what was it, Wednesday, I think. That's what happens at a top. but it also happens from time to time when things go up too far. So you have no idea. One part, going back to the heat formula, I tell people always have hedges, and then, trade based on what you see, not based on what you think. So what I see is I see a bull market. So as long as I see a bull market, I'm going to be long. We also do a podcast. I had a guy on a couple of weeks ago. He's been short for 2 years. And his argument for being short for 2 years is a great argument. He's losing money hand over fist, though. So it's like, yeah, I mean, okay, that's just not me. I mean, I don't disagree with anything he's saying about being in a bubble, but a bubble can last for a long time, and I'm going to enjoy it while it does.
So it's the Michael Burry sentiment of, I'm just going to sit here and I'm just going to ride it out and just bleed slowly until I'm right.
Exactly. And sometimes, like in the case of Michael Burry once, not every other time, you become a billionaire. But I think most of the time, you lose all your clients and you lose a ton of money.
Mm-hmm. I've noticed that there's a big push for the lower the interest rate. And I think that has to do with, this is what I see, that because I know that Trump had placed a $100 million bet on the interest rate. So as interest rates fall, he makes more money. Do you think that's what the like this whole thing throughout the year, the ups, the downs, sideways, is to force the economy down?
No. So, I think Trump is trying to run it hot. And he's playing what you could argue is a dangerous game, but you could also argue the Fed's behind the times and has consistently been. So Trump definitely wants lower interest rates. There are advantages to that. I mean, for stock investors, lower interest rates are great. For guys who are selling income products, lower interest rates are great because, not as many alternatives. For people who are in debt, and I mean, the debt out there, personal debt is insane. And for the federal deficit, lower interest rates are a good thing. So, I think that's where Trump is going. And I think the fear in the marketplace, and whether it's founded or not, is when you've got a president who's only in for 4 years, their incentive is let's run it hot. And whatever ramifications there are from that, which would typically be higher inflation, that's the next guy's problem, which is why people like putting that in the hands of, say, the Fed. Now, that's all well and good. I mean, the Fed's got their own, things going on, and, who's to say these guys are right? So it's going to be an interesting battle to watch over the next 3 years to see if Trump gets what he wants.
So what you just pointed out something interesting. If the interest rate falls, equities rise, that's actually bad for people that are covered calls, because covered calls are actually a bearish strategy. So you're getting capped out.
That's bad for people who are doing weekly, monthly, and quarterly, not guys who are doing zero DTE. And then we're also about to launch a bunch where we're selling puts. So it's all good for what we do. Let's say it all plays out into my hands. So, and I have nothing to do with Trump trying to lower interest rates, but I am cheering him on a bit.
Yeah, you got the inside scoop. I know you do.
Maybe
he'll be at the next CBOE ringing the bell with you.
I would hope so.
All right, so that's terrible for your competitors. Definitely. Where can people find out about the heat formula? Can you touch more on that? Like, what is that? It's an acronym.
It's an acronym for hedges, edges, asymmetry, and themes. So the idea is you should always have hedges, because we don't know. I mean, are we in a bubble? Probably. Could it last 10 more years? Yeah. Could it end tomorrow, or tomorrow's Saturday? Could it end Monday? Yeah, we don't know. Always have hedges, and bonds are not a hedge. To qualify as a hedge, it's got to work every time. And we're going to have an ETF for that probably next year. Edges means you should always look for structural or behavioral edges in the marketplace. One of the reasons I like selling puts, selling puts on stocks that are not likely to go to zero and where you're cash covered, because most of the time, if you know what you're doing, your put's going to expire worthless. So
Like
to me,
NVIDIA.
that's an edge. What's that?
Like NVIDIA.
Exactly. Asymmetry, we talked about, designing your trades in your portfolio for asymmetrical returns. We do a podcast. We interview a lot of legendary investors. Everybody is different. There's no right answer. But what everyone has in common is when they're right, they make a lot of money. And when they're wrong, they don't lose a lot of money because you're always going to be wrong. And then T is for themes. I am a big believer, as I said, this market has become thematic and it's not going back. You want to be invested in today and tomorrow's top themes. No reason to, be in anything else. I mean, you saw it with the quantum stocks. This is such a target rich environment. So, I was on Bloomberg last week. The host is like, hey, what about bank stocks? I'm like, who cares? It's such a target rich environment. Why would I buy JP Morgan? I mean, yeah, could it go up? Yeah, it could, but I'm going to make much more money in quantum drones, nuclear, on and on and on and on.
Yeah, it doesn't make any sense. But
yeah, and so we've got a newsletter we do on that every day. It's free. Go to my website, tuttlecap.com. You can get it.
Okay. And that's for the heat formula.
Correct.
Okay. Now, what about, are the ETFs listed there as well? Where would they find ETFs?
The ETFs are on my website as well, tuttlecap.com. And then we also have an ETF specific. So for our income ETFs, it's incomeblastETFs.com,
I think that's right.
Hold on. IncomeblastETFs.com. Yeah. And there we'll have BITK and MSTK. And thanks to you, we will list our distribution on the day that it's being announced. We're new to this space. I'm still learning the intricacies. So yeah, I mean, people like you hitting me up, people on Twitter, like, where's this, where's that? All right. We'll do that.
I'm seeing a lot of kickback about the 15-cent dividend. You want to give some sort of...
Yeah. So, and that's a great point. I'm glad you got to that. So going back to being intellectually honest, when we launched BITK, we, again, being unencumbered overnight, we had like 3 days where IBIT gapped up big. And so it comes time around for me to declare the first distribution, and we're sitting on massive gains. And I've got a saying, I don't know whether I came up with it or not, or whether I heard it, but for argument's sake, let's say I made it up because I like it a lot. It's when you're about to pat yourself on the back, take profits. So I'm sitting there, we've got massive profits. Now, I think a lot of people look at that and say, hey, if I've got massive profits, that means I'm going to have more massive profits. I look at it saying, I bet Bitcoin's going to mean revert. I want to distribute a lot of these profits because to me, that's the right thing to do. Now, that also meant a 300 and something % yield, which I did not intend to come out and say, hey, here's this shiny object, but I wanted to give you your profits back. And it turned out I was right. Bitcoin tanked after that. I think what I want to do here, again, having an intellectually honest product, is there's got to be some balance when the underlying is going down. What I don't want is to say, hey, I'm going to distribute 100% yield. Oh, and by the way, a year from now, my share price is $4. I don't want that. I mean, I could do it. I don't want it. I don't think that's intellectually honest. I think a 40%-ish distribution yield, now that we've had a couple of weeks of seeing how this works, I think that's where we kind of want to settle out. but I think there's got to be a penalty if the underlying is just going down in a straight line. Because again, I don't want to give you back a bunch of your principal. But I also think there's got to be a kicker when the underlying is going straight up. And yeah, I do, because again, I believe you've got to take your gains along the way. The other saying I like that I did not come up with is take your gains before somebody else takes them from you.
Oh, I like that.
Yeah, I like that one too. I wish I made that one up. That when you're ready to pat yourself on the back, I don't remember.
So I guess my thought process is at some point, like if you're saying that we're gonna, if we can hope for 40% returns on good days, but on bad days, you're still actually beating you're still beating the underlier. Those 40% returns reinvested, like if what is it? The IBIT is going 10%. You guys should eventually. You're just going to gap away from that because you're.
It is quite possible. Again, what I love about zero DTE is you've got the ability to outperform the underlying. Really, the nightmare scenario on zero DTE, and it happened to Cy, was the day that Trump came out midday and said everyone buy stocks, and the market gapped up 10%. Now that's going to impact the weekly, monthly, quarterly guys too. But as a zero DTE guy, you're sitting there saying, "Hey, I've got an advantage," and then Trump pulls a fast one on you. But outside of those events, over time, we ought to be able. Again, I mean, no promises, no nothing. There is the potential to outperform the underlying in an up market, which a traditional covered call ETF, if you do the math, if you've got an up market in something, you're not going to outperform. You're just not.
Mm-hmm. Is there anything in the prospectus to where you could throw a put in there if you see Bitcoin shoot down to 60? Like it has just as much probability as going to 60 as it does 180.
So the way I look at that is I don't want to do that. I look at the risk side because, again, I'm a trader. If I buy something, it's because I think it's going up. I'll deal with the risk. If I'm wrong, I'll sell it, or maybe I'll buy a protective put underneath myself. I'm going to deal with the risk. I kind of look at that the same here. We're giving you something where exactly what we're doing. Like if I say, hey, we've got the discretion to buy a put, well, all of a sudden you don't really know what I'm doing. Hey, Bitcoin's going down. Does Matt think it's going down? Who died and made me an expert on Bitcoin? So I don't want to do that. To me, it's like, hey, you, Mr. Shareholder, you decide. You don't like the risk, you sell the product, or you don't like the risk. Maybe you're long BITK and you're also long a put on IBIT. All sorts of different things you can do yourself. So that's why I don't want to do that.
So would that be in this case, would that be the hedge? Is doing a put on IBIT to protect the downside?
You could very well. And in fact, I don't think that's a bad idea. Like, hey, go long BITK and, what's IBIT? 62 and change. Maybe you buy like a disaster put at like 50 on IBIT or something. So then you've got a known downside. And at some point when we get some volume, we'll get listed options on this as well. I don't think there's a whole bunch of interest to buying options on a covered call product, which is unfortunate because I've looked at some of the products out there and they do have listed puts. And from time to time, I buy the puts, but they're just not that liquid and your fills aren't that great. Because there are a lot of covered call products out there I think really suck that I would love to, on a fairly consistent basis own puts on. I can't get filled well enough to make it make sense as a real strategy, unfortunately.
It's that one that just fell like 40%. It's floating around 4. Is that what you're thinking?
I mean, there are a few of them. I mean, if you look at, the individual names, like, if you own, let's say, MicroStrategy, you could buy a put on, say, a MicroStrategy covered call ETF as a nice hedge. And in fact, I actually came this close to launching an ETF that was 100% long MicroStrategy and 100% short one of the MicroStrategy covered call ETFs. And back testing it from inception, you would have been up like 75% because
Wow.
because of the erosion. The problem is because you're paying financing charges to get 100 and 100, you're short, you're paying out the dividends, you really need the underlying to move. If the underlying doesn't move, then you're just kind of, flopping around, and it's really not that interesting.
Well, that's basically a straddle, right? Where you're paying up the premium. You don't care if it takes a direction, but it has to be more than your premium you're paying
I
out.
mean, it has to take a direction. If it's just choppy, and I had an ETF on this, then we're paying financing charges and really not going anywhere. You really need like something to go straight up, and then we would crush it, but you don't know. So really, that's more of a strategy that I look to do in my personal account, not as an ETF.
Do you have any interest in doing now? I don't believe you guys have like a fund of funds, but like a Mag 7 or a Mag 10
We,
zero.
we are doing a Mag 7. We're doing a bunch of thematics. So the next generation of the income blast ETFs will be either single names or thematic baskets where we're writing puts underneath. And we're going to do put spreads underneath. So that way you've got unlimited upside. Again, we're not putting a call on top. We're not capping anything. So, if the underlying goes up, you make money. We're going to be in synthetics. You make money on the synthetic, and your puts expire worthless. You make money on those as well. So, yeah, we got a bunch of themes, and Mag 7 is one of them. Meme stocks is another one. I've seen like some meme stock ones out there, and I have a pretty good feeling I can do a pretty good job picking some of the stocks that should go into a meme stock, put right ETF.
But you'd have the availability to swap those out, right? Like, because if it's thematic, you don't want to be beholden to something for 5 years when the entire market
Well,
changes.
so we're gonna have a mix. So like we'll have specific like nuclear theme. So I'm not gonna get cute. You decide, hey, I want access to nuclear, or I don't want access to nuclear. Up to you. But our meme one, yeah, we're gonna be moving that around based on where are the hot themes, where are the hot stocks. There's going to be some sense of because we're writing puts. I mean, we're doing put spreads, but I don't want a company to go to zero. But yeah, I mean, we're going to be moving that around based on what's hot and what's not. And who knows? Maybe we'll do a fund to funds. I was against it, and I was doing some podcasts, and someone said, well, hey, people in different industries really can't buy like a bunch of different stuff. So putting it all in a package makes sense. So we'll
Yeah.
look at that.
I have some friends that are in banking or their spouse will work in banking and they can't touch any of the single ticker ETFs. They have to buy, an Omaha fund, or they have to buy one of these big conglomerate.
Yep. Yeah, I wasn't thinking like that. So yeah, we'll look at that.
Um, do you think AI is going to replace the workforce? Or is it
I
going to be
think
like
AI.
solar?
What's that?
Is it going to be like solar in the 70s where it was just like a big boom and then it crashed to nothing and now it spiked back up again?
I think AI is going to replace a lot of things. Give you an example. So I hired a guy last year to do some tech stuff for me. And he told me, hey, I'm going to do this, this, and this for you. I'm like, this is awesome. It didn't work out. We had to let him go, and he didn't end up doing anything. So what I did, and I'm old, I don't know this stuff. I took the list of what he said he was going to do, put it into ChatGPT, and ChatGPT taught me how to do it.
Oh, wow.
So, and we have now in place all of the things I hired this guy to do. I never needed to hire him. So I do think it is going to be a game changer. And, when you are younger, and I've got kids in their 20s. I mean, that's something I hammer home to them. I mean, you want to be like, eventually it's coming for just about everything, but you want to be in that, the last industry it's going to come for. Um, again, it goes back to hedges. Hedging is not just for your portfolio. Hedging is for every aspect of your life. Being a trader, I come at everything from a trader mentality. Look at the downside. The upside will take care of itself. You do the right things, the upside's going to be fine. Take care of the downside always. Always look what could go horribly wrong, and how you can get around it. So, we're always looking at things like tokenization, the new potential of 3x ETFs. There's always dangers to our business that we're watching and always thinking, how can we mitigate this or eliminate this risk? And I think AI is going to be a big one for a lot of people.
Is there a future for traders, or if everyone can just make a bot and the AI trades it? Is there will you have a job anymore? I see you have your computer screen. Like, is that going to be obsolete?
So I think not, because I think there will always be a place for people who are smart on stuff. And there is never one right answer on investing. So now what happens if we're all using AI to decide whether to buy NVIDIA? I think that presents opportunities for people who are not using AI to then see, all right, what is AI doing? So, all right, Dan's using AI. What's Dan doing? All right, maybe I'm going to fade what Dan is doing. I think there's always going to be opportunities for smart people. One thing where I think it'll crush people. So I use AI to help me in my portfolio because I don't have time. So I'll use AI to do research and things like that. And it knows me now. It knows what I'm invested in. And I get a lot of Wall Street research. I think it's mostly useless, but every once in a while there's a nugget. I don't have time to read it. So I'll put it into AI and say, hey, anything in here I should be aware of, basically. I mean, I'll be more sophisticated than that. And I remember one day it hit me. So it told me, you know what, you should sell, this stock that I own that I was thinking of selling anyway, and you should buy this stock. It's like, that's interesting. And then the magnitude of that hit me because back in another life, I was a stockbroker. And it hit me that for $200 a month, I am getting unbiased, personalized financial advice from basically a combination of all the smartest minds in the universe. The implications that has for all sorts of financial advice are massive. So it's gonna be interesting, and you've got to be prepared for just about everything.
So would that pose the idea of maybe going short financial advisors?
Could very well be. I mean, you always want to look. So what I tell people in themes is there's a hierarchy. Who are the winners? That's the obvious stuff. The next level is who are the suppliers to the winners. That's where once the winners have run, that's where your alpha is. Then who are the suppliers to the suppliers? Because eventually everyone's going to figure out the suppliers. And then the fourth level is who are the losers? Who are charging for things that are going to become obsolete? And the losers are going to be the Wall Street firms, the financial advisory firms that are charging you for things that you don't need anymore. And, in all aspects of financial advice, like if you want insurance, Man, where do I look? I'll go to an insurance broker. That person's probably biased and may not give you the best policy. But let's say I put into ChatGPT, hey, I'm 30 years old, I'm this, I'm that, I smoke, I do this, I do that, give me the best policy. Boom. All right. Yeah, MetLife, term insurance, 500,000 bucks, cost you $50 a month. Here you go. I mean, that's a game changer.
But for something like an annuity or a life insurance, if you ask ChatGPT, hey, replicate what an annuity is, but use the SPY, and it spits out the algorithm, is that too complex for the average person?
I mean, some people, so I'm an ETF guy. You could pretty much in most of my ETFs recreate what we're doing. Why do you go and buy an ETF? It's an access vehicle. So could I buy the 500 stocks in the S&P 500 in the exact allocation that they're in there? Sure. Would I just buy SPY instead? Yes, because replicating it's a pain in the ass. And for 9 basis points, screw it. I'm just going to buy SPY. Mm-hmm. So, it depends. Now, going to say annuity world, there's a bigger advantage because the fees are higher. So I'm not going to replicate SPY at 9 basis points. But if you say, hey, Matt, SPY is now 5%, screw that. I'm going and buying the stocks.
Mm-hmm. Yeah, yeah, that makes sense. But what I meant was, do like the people that sell life, they got a Series 6 license, they're basically going to get chopped out because they go, well, I can buy, 100. If I'm going to give anyone 100 grand, I'm going to give it to Matt. He's going to put it in one of his ETFs, and I'm going to ride that baby for the rest of my life versus putting it in
the other area they're going to get chopped out. So, talking about the shiny object and distribution yields, the annuity side of the world also has a lot of shiny objects that aren't what they appear to be. But I don't know that. You give me a sales pitch. I'm not an expert. Wow, this sounds awesome. Let me ask ChatGPT. Hey, here's this annuity I'm being pitched. Here's what I'm being told. Evaluate this for me. Oh, you know what? No, that doesn't have unlimited upside. It actually caps your upside. Here's how it would have done. Last year the market was up 30. Yeah, you would have only been up 4. Here are the risks. Here's this. Here's that. Totally unbiased. That's going to make things really interesting.
Mm-hmm. This kind of back and forth we have with Venezuela right now. If I'm looking at if we're going to make a deal with them, because gold is super high, they have a lot of gold and oil. I would almost be saying I would kind of short gold and oil if we make a deal with Venezuela because they have nothing else to trade with the U.S. other than that.
I mean, I think that's the right type of thinking. But you got to look at the overall landscape. So you've got central banks buying gold. You've got investors buying gold because of the debasement trade. Is that enough to mess with that gold trade? I would argue probably not. And I'd still want to be long gold. Oil isn't something I follow as much because it's just, it doesn't really do anything. I did write my newsletter the other day for the first time in a while about oil stocks, and I bought a few and I'm making money on them, and that's cool. I don't know that oil stocks are something I want to hold long term though. So I'm not as cognizant of that market just because I don't really care. But I think, you got to look at the overall, what's going on in the Middle East and all of that as well. But I think that's the right thinking is, you want to be looking at things like that. That's where you're going to generate alpha.
I heard that, and maybe you have better insight than me, that the big bank that oversees all the Federal Reserves in Basel, Switzerland, is moving gold to a safe asset to Basel 1. Do you know anything about that from Basel?
I don't know anything about that. No. I mean, I do know that people are buying gold hand over fist. If I didn't own gold, would I buy it now? I probably wouldn't. If you look at the chart of like GLD, it looks like the chart of like Rigetti. So which it shouldn't. So again, it goes back to my, hey, when you're patting yourself on the back, take your profits. So I would wait for gold to maybe settle out a bit. I mean, I've kind of been tempted. All right, it's up now. Yeah, I've been tempted to buy the dip and I've nibbled the drop, but I really haven't gone in big on it just because I do think it needs to settle down a bit here.
What is your reversion to the mean average on gold?
What's that?
What's your reversion to the mean average on gold if you had to pick one?
I don't know if I could pick a level. I like to look at charts, and it's kind of things when you see it. Like when you look at a chart of gold and it looks like a chart of Rigetti, do you want to be buying it? Probably not. Because it normally doesn't move like that. And I am a big believer in reversion to the mean. Things revert to the mean all the time. And you've just got to expect that. I think we'll get a better entry point. If you were saying, hey, I'm going to buy and hold for the next 30 years, all right, who gives a crap? You buy it here, that's probably fine. I just, I still have a trader mindset. I don't have time to trade, so I have to be much more a long-term investor than I like. Mm-hmm. But I still can't look at something saying, hey, I'm not going to watch it. I'm just going to hold it for 30 years because I'm going to watch it every day. And if I buy it and it goes down, I'm going to be pissed.
It's reflexivity is what I call it. When you pull a rubber band up and it goes, and you let it go and snaps back really hard, it's violent.
Exactly. And you also typically want to be doing the opposite of what most people are doing. And when every newspaper article you see is how great gold is, you probably don't want to be buying.
I got two more questions for you. And I'll tell you what they are because I know you got to go. And then you can kind of answer them at your own speed. What can investors expect from Tuttle Capital? Anything you can publicly announce or tell us here. And the second one is, if you could go back and tell your younger investor self something, what would it be?
So what to expect from Tuttle Capital? We're always going to try to be on the cutting edge. I'm always going to look at every marketplace and say what could be done better. We're always going to try to be intellectually honest with what we're doing. We want to provide a wide variety of tools. So we're doing much more on the option income side. And again, we're coming at it differently, 0 DTE and puts. We're coming out with something on the tail risk side, which is going to be revolutionary. Hopefully that'll be out in the first quarter of next year. We'll continue to look at thematic stuff. I mean, I'm hoping against hope that I'm able to launch my Grift ETF, but right now every exchange has told me they won't list it. So we're being censored. We'll come out with creative stuff that you'll be like, holy crap, what are those guys thinking? Like my UFO disclosure ETF. Mm-hmm. But there's always a method to my madness. What would I tell my younger self is the one thing that always bugs me is in the late 90s, looking at Amazon and not understanding why their market cap could be bigger than Borders Books and Barnes and Noble combined, and not buying it and holding on to it. You're like, dude, Amazon's going to dominate the world. Buy the stock, hold it.
That's it. What brought you to that conclusion, though?
I mean, it's one of those things back when I was a broker that you'll never forget is talking to somebody and, about Amazon. There's just like, yeah, I don't see it. I mean, how can this online bookseller be worth more than Borders and Barnes and Noble combined? Doesn't make sense to me. I wasn't looking at it in 3 dimensions, realizing online is where everyone was going to go. And if they expand into all these different areas, then of course they're going to be worth more than those things.
Is that
now I look at everything 3-dimensionally and not just, I mean, you can't look at just what's in front of you. you've got to also look at it from 3D. Yeah, and I don't know what's going to happen with Tesla, but Tesla is a great example of that, where Tesla is the most hated stock in the US. The Koreans love it. But if you look at Tesla and say it's an EV company, is it overvalued? Totally. But if you look at Tesla and all the things they may do in robotics and AI and all that, is it overvalued? Maybe it isn't. And again, I'm not saying I like Tesla or I don't like Tesla, but that's just, I think to be a bull on Tesla, you've got to be looking at it like that. And if you are, the future will prove out whether you're right or you're wrong.
Interesting. Okay. Yeah, I suppose that makes sense. Is that kind of the idea with like NVIDIA, where they're buying up all the different AI, they're getting in deals with AMD?
I think that would have been the idea behind NVIDIA a couple years ago. Like right now, I mean, we know what NVIDIA is. And I would also argue there's probably, I think you got to own NVIDIA. I don't think there's a lot of alpha to just buying NVIDIA now and holding it. I think it's something that's got to be in your portfolio, but I think the people who made a lot of money on NVIDIA were the people who bought NVIDIA a few years ago because they saw what this could be. They understood, because I think when NVIDIA first came out, these GPUs were for gaming. And if you're just looking at it like gaming, maybe you're saying, and especially someone my age, I mean, I haven't played a video game in like 40 years. Who cares about gaming? But you've got to realize, but wait, this could be so much more. And the people who realize that are now stinking rich because they bought NVIDIA and they held it.
Those same gaming cards are used to mine crypto.
There you go. And if you had thought of that, you're stinking rich.
Interesting. All right. Well, I mean, that's great. Anything else you want to share before you go?
No, but keep the comments coming. I'm now getting involved in this whole option income community, and I know these guys are passionate and understand we're new. Some of this stuff like, hey, put the distribution year, put the dividend announcement on your website, this and that. Reach out. If you see something, say something. I try to reply to people when, from a compliance perspective, I can. Sometimes I just can't from compliance. Like if you ask me, hey Matt, what's your fund going to return tomorrow? I'm like, I can't tell you that. But if you're going to say, hey, this should be on your website, I want to hear it.
Okay. Well, that's great. Thank you so much. And do you guys post the new funds that are coming up that we should expect to be on the lookout for? Will that have its own page somewhere, maybe on the website?
I mean, each one will have its own page when they come out, and we'll do some like coming soon stuff when they're close.
Okay. Well, I look forward to it. Thank you so much for taking the time to talk with us today.
Yeah, thanks for having me.
All right. Thank you so much. Talk to you later.
All right, thanks.